Stagnation, welcome back to the channel, the one and only channel. Soon as we appear, there we go. Now, we're actually going to be starting this show with this chart right here, which Double is going to pull up. This chart is probably the most famous chart at this point in time, probably seen by the whole world. This is a result of what happened after the Federal Reserve fired up the money printer after the pandemic showed itself, right? And at no point in time in history have we ever seen this sort of useless value, right? I don't know if you can say useless and value in one sentence because, or this sort of useless activity rather, ever in the monetary system.
This is what made that GIF very popular.
Exactly.
Go brrr.
Yes, money printer go brr, right? This was an experiment, a horrible experiment, and at this point in time, we are seeing what happens when something like this happens. This is not to say that the Federal Reserve is not, they do not go to economic school or they do not understand the idea of Austrian economics, which is partially what Bitcoin is built on. Well, actually, very much what Bitcoin is built on. Spending within your budget. I understand. People might go, well, you know, it was in response to a situation that is unprecedented. But you're supposed to do some analysis before taking action on anything. Furthermore, we know that these guys knew that something was going to happen.
They experimented on everybody. I think it actually started in 2008 when they came up with the new term quantitative easing.
Yes, quantitative.
QE, baby.
Well,
QE to hell.
as we are seeing quantitative easing, we're also seeing the other side of that, which is called quantitative tightening.
Yeah.
They say what goes up must come down.
True.
Well, I think that idea is about to be defied right here, at this time in our lives. Now, as we know, the Federal Reserve has been doing some quantitative tightening,
Yeah.
trying to pull back some of this liquidity out of the market,
Yep.
right? And trying to get us back to a point where inflation can be back down to about 2.5% is where it was.
So they say. But
So
they're trying to get us to 5% first. And then somehow find a way to bring us back to 2%. How?
Okay. Well, here's the thing. We're no experts, but here's one thing. Thank God we went to school because we can read some basic things, and we are going to be using the work of some very, very smart people. In this case, we see liquidity dependence. Why shrinking the central bank balance sheet is an uphill task. This is by Rahuram Gajan. Oh, Rajan. I did
God,
the
why
G.
did you say
I
that
did the
G
G.
there,
My
man?
apologies, sir. My apologies. Your work is very smart and looks very great. From the University of Chicago, Booth School of Business. I don't know what they teach in Chicago School of Economics, but great paper.
Yeah.
But you know, the products that you guys have out here right now are printing a lot of money.
Yeah.
Now,
Of course, you're going to have one of those few black ships that says, hey, guys.
you know, they are just listen. They all usually look like they're on the straight and narrow until they get into government. Look at Gary Gensler. You know, he was teaching Bitcoin at one point. Yet, he's there printing money like he does not understand the concepts of this thing.
Well, Gary Gensler doesn't get to print. Jerome gets to print. Gary Gensler gets to cheat for.
Yes. Gary Gensler is that's a whole different. I'm mixing them up.
No,
They're all both equally terrible at their job.
SEC not doing the job, protecting the people
Nobody
like they
is
said they
doing their
will.
job, right? So, now, what are we talking about here? We're talking about this idea of quantitative tightening, which we're seeing is causing a lot of stress on the country, as we can see right now. It is possible, and we did another video earlier in the week where we talked about banks have failed at this point in time, and FDIC would have to jump in. This is a major piece of that,
Yeah, it's part of the equation.
right?
Yeah.
So as we go through this, do we want to where do we want to start? Because we have some short videos which we're going to share with you, and of course some concepts from this PowerPoint which we're going to share with you.
I think we should start with the visuals first, so that it's
start
not
with visuals.
coming from us. It's not coming from our analysis.
Absolutely.
You guys actually see it from their point of view, and then we'll now have a conversation with you guys. Let's think about what we see, what you guys are saying. You can comment about that and let us know what your thoughts are as well.
Absolutely. Well, let's jump right here into the PowerPoint activity. I feel like at some point in time, we're always doing TA. We always had a chart with us. And now we always have a PowerPoint of some sort to show you. Now, this is dependence view, liquidity demand affected by reserves. So what this is showing here is a supply of reserves. And these reserves are, this is supplied to the banks by the Fed.
The Federal Reserve prints the money digitally, some number somewhere, and then now tell the banks how much they can have. They say, okay, your bank has X, Y, and Z.
Exactly.
And then the banks get to do some magic with those.
So when the banks are holding those reserves, then there is going to be some demand on that liquidity. Now you could spend within the budget, right? Whether you're going to be giving out loans or whatever sorts of transactions you're going to be carrying out, you could do it within that budget. However, this is not what the banks do.
They don't.
They borrow, they essentially leverage, cause a leverage situation on the money.
That's basically how the banks make their money.
Okay. So now you have, let's say for every $1, when they have a credit claim on that $1, now you have new liquidity, which has been written by the banks on this same fixed amount of money that the Fed has given them. And now at this point in time, when the Feds are engaged in this act of quantitative tightening,
calling the money back,
they cannot pull out all the money because they cannot request or they cannot pull money that they never put out there in the first place.
Yeah, it's like they give the bank $1, but the bank has messed around and have given out maybe $10 worth of loan on that $1.
Definitely.
So the Federal Reserve saying they want to pull back that dollar. The banks have so much liability. It's like, well, where am I going to get the money from?
Exactly. And now they're owing money, which they never had, it seems like.
And now they're telling FDIC, oh, come on, man, we're too big to fail. You guys can take care of it for us.
So they're expecting a bailout of some sort at this point then. Now, this is reserves and claims percent of, and reserves and claims, right? And this is now represented here as a percentage of the GDP. And we can see that over time. And the main one we really want to pay attention to here is this area with the pandemic QE. Now, previously, we saw some QE there, 2008. Was it 2008 crashing? We saw that QE was essentially a bunch of useless money in the economy. And then they tried tightening over time. And now we are back to all-time highs.
It seems like each time, because we got to engage in this quantitative easing business, right? And the moment we feel like, I would think that we've had too much money in the system, we want to do this quantitative tightening, which they kind of do with this whole inflation and not buying as much bonds as they were buying before. By the way, that whole bond buying thing is a major scheme.
What is that about?
The federal government buying corporate bonds, basically propping up certain companies that they think is good for the economy, and then giving them back to everybody to buy at certain percentage interests back. And the moment they start pulling back on that, those companies either start crashing, they start seeing the impact on the economy, then we have this all inflationary impact. And they're like, wait a second, we got to pull back. So that's what they call the quantitative tightening. But the moment they start pulling back, it looks like the economy wants to crash.
Well,
because the bond yield flips.
Yeah.
So now we got to jump back into quantitative easing before you know it.
And I think it also starts crashing because of all the excess money that is in the system. Now, you see, if back in 2000 and, 2018? No, 2000, about 2018, after they had this pump
QE.
of money here, right? First of all, they started doing some QT, some quantitative tightening, but they never made it back below the levels
Where they started from.
of what, let's say, in this chart, we should call that normal. Right. And now we are now pumped up above where it was in the past. And now this means that there's even more leverage. Like, I'll just put it that way, in lack for a better term. Right.
More leverage in the banking system.
Exactly.
And we're not expecting the FDIC to cover that, which we discussed in the FDIC video that we just did, which now means that we thought 2008 was a big Lehman crash financial situation. We might have one that is not even related to the real estate. It's just the fact that the banks are extremely over-leveraged.
Insane. Now, we see this other chart here is just showing reserves, the bank reserves. That is going to be the blue line. And then, of course, the deposits as well. and that's on the green line there. And we can see that the deposits were rising as the bank reserves were rising during that QE there, which it seems like that makes sense because, you know, everyone was getting the money and they're
Yep.
putting it into their bank accounts.
Yep.
But the interesting thing is, you start to see as the bank reserves, as the deposits start to drop, right? There was a moment there where the bank reserves were still going up, but it seems that the bank reserves now would have to be pulling back as this quantitative tightening is happening, and there will also be no deposits with the quantitative tightening situation. Now, the interesting thing with that is that it sounds like at some point in time, even if they took back all the reserves from the banks, there is still going to be debt out there that comes from extra fake money that was made by the banks. So technically, that means quantitative tightening is not necessarily working.
It's gonna be that difficult for it to work in the long term.
Right.
Like, you know how QE can take several phases.
Okay.
And it's easy for you to put the money into the system. It's not easy to pull the money back because where is the money? It's all liabilities now, and where are the folks gonna get the money to pay it back? Well, if you're calling it back, if they're already indebted in the first place.
Absolutely. Now, here's the other interesting thing here. If we're doing, let's say, if you're trying to pull back all of this money, right, and the money is money that you never actually lended it or created it in the first place, right, then you start to see that you cannot actually pull back all of the money because it's just the math is wrong at that point. The money does not exist from the Federal Reserve side, right? Now, this other chart here just shows demandable and time deposits. Is just a representation of time deposits and demand deposits. Now you can see it's really sort of a similar thing. Now, time deposits, that is pulling back during the quantitative tightening because people don't have the funds anymore. And then you have the demand deposits, which is also sort of following in the same direction, but not too heavily.
This kind of connects to the old repo market conversation.
Right.
That's another old thing that we can talk about that we're not going to jump into right now.
Yeah, not necessarily.
Yep.
All right. Now, let's jump into some of those short clips there and check out some of these explanations because I think they did quite a good job. All right, we're just describing what is happening here and why this is something that may not actually work, the quantitative tightening, and what happens after this.
Yeah, how does all of this stuff we just talked about impact your money? How does it impact your wallet? Because your and I's money is in the bank. So if all this stuff is happening in the background, somebody please tell me what's going to happen to my money.
Exactly. So the first one here, it says, why do banks not shrink liquidity claims when reserves fall? Which is the most insane part about it. You would think that they would start getting the act together, knowing that the money can be recalled.
Even Grant Cardone said it in one of his videos, is that his fault the last 2008 crash was that it wasn't big enough to fail. Because the banks will rescue him or the federal government will rescue him. So now the banks this is the part that is so disingenuous about banks. I don't work in the banking system, so if you work in the banking system, you probably don't like me. But I know people that have worked in the banks that have screwed me over. So I will gladly talk about it. Is that they know that what they're doing could destroy the markets, but they know that the goal is to be too big to fail because that's when you get rescued.
Well, Grant Cardone is an idiot. Moving on.
Don't call him an idiot.
He's an idiot, bro. The guy's a freaking idiot. It's just what it is. It's just how I feel about him. Nobody knows. It's just me. But he can hit me up. Not that he's actually going to hit me up. But moving on, let's play this video.
In times of need, since stress will show up in treasury repos, if the Fed is automatically programmed to intervene when stress shows up, then you can rely on Fed intervention. And then what are the costs of Fed intervention, right? One, of course, is the market underprices liquidity, enhancing the need to intervene. It's very easy for the Fed to get in, hard to get out. The notion being of a whirlpool, you get in when you do QE, but very hard to get out because the system sucks you in again and again. There's a distortion in financial activity. You tend to do Stuff that requires liquidity, speculative activity is something that comes to mind. Requires infusions of liquidity when you make big losses, but that may be what you are driven to. And there's a distortion in real activity. If financing becomes real short term, then what is it that you finance? Short term real stuff.
Yeah. So fake money, financing
More fake stuff.
more fake stuff. So
Financial liabilities.
yeah, so it's a bad combination altogether. Now, this next uh, part of the volume of the of the video here, just speaking about the moral hazard of banks, right?
Times of need, since stress will show up in treasury repos if the Fed is automatically programmed to intervene when stress shows up, then you can rely on Fed intervention. And then what are the costs of Fed intervention, right? One, of course, is the market underprices liquidity, enhancing the need to intervene. It's very easy
Is
to
there a
Fed for the
repetition of the
Fed to
previous
get
video?
in, hard to
Is it?
get out.
I think so.
Oh, let's see here. We have, I believe this one speaks more about QE is a non-stop activity. Now, one thing I'm gathering from all of this as we're watching these videos is just that we seem to be in a situation that is mathematically impossible to win. At this point in time, it would seem that the logical thing to be doing is to be trying to look for an alternative instead of continuously driving down this path that seems to have gotten society in a bind as it is. Changing our ways will be the very first one. Do not spend money you don't have. Do not create money out of nothing. But let's carry on here.
Tremendous amount of money printing. Actually, it's not actual money, but it's reserve creation. But there's been a tremendous
Can
amount
you
of
pause
it
that real
since
quick?
the
Yeah,
Did you hear him say?
reserve creation.
No, he said that it's not actually money.
Yes,
You
reserve
can
creation.
Yeah, it's reserve creation,
Yeah.
which is basically that guys, we're not saying this. This is the folks that are in charge of all of this. They're literally saying that the money that you and I are spending is not money. It's just reserve creation, ability for them to create liabilities, for the banks to for them to create. I don't know what to call it, assets. Create money to create liabilities that keeps us all in this entangled mess.
There is no value.
There's no, well, they create value under the name of the U.S. government.
There is no value. I don't see the value because if it's not backed by anything, then technically
It's backed
it's
by the U.S. government. It's backed by the U.S. military.
What does that mean?
It's backed by the U.S. economy.
What does that mean?
Anyway, the bad news.
There is nothing there. It's just
global
because
financial
you
crisis.
you cannot go cash in a piece of the U.S. government. You cannot go cash in a piece of the U.S. military. It's just not a thing. So it just seems like there is no value. It's literally a scam. Is what we're living in.
And what this involves is the central bank replacing long-term bonds of a variety of kinds with perhaps the most liquid asset on the planet, which is central bank reserves. And so the big question is, you've put all this liquidity out there, and yet there are surprisingly fragile conditions in money markets, especially when you withdraw some of this liquidity. And remember, you're withdrawing from levels which are many times higher than when you started putting the liquidity out. So what's going on? You had the repo rate spike in September 2019. You had a tremendous dash for cash across global markets in March 2020. And of course, recently we had the turmoil in UK gilts in September, October 2022. The broader question.
Well, we have that. What are your thoughts on that?
I think just listening to all of this, because I watched the entire video, guys.
Right.
And
yeah, and we'll drop the link in the description when we post this, so you can always check it out yourself.
Yeah,
highly recommend it.
If you're not a finance student, it's very difficult to understand. I took 2-3 classes of finance when I was in school. But what this is just trying to get us to understand is that the system itself, the way it's designed, is quite faulty because not only are the Feds doing what they think is right,
Yeah.
the banks also think they're doing what is right. So you and I, as consumers, are just stuck in the middle of everybody thinking that they are right. Whereas your money is just getting screwed. They decide to inflate the market tomorrow. You just
Right.
wake up and you know what's worse? It's bad for African countries because they just
Oh, I mean, African countries have been dealing with this thing their whole lives. Like they're just fake money everywhere. No real value. Yeah, I don't think you really need to be at some point you don't really need to be an economic student or a finance student to get these things. I think if you're someone who is working and making money, it is in your own benefit to understand what money is. It is in your own benefit to understand what you call value or what we call value as a society. Unless you just want to be getting screwed over, yeah, that is fine. This is why we do these videos, because I think that at some point in time, all of us as a society really need to wake up and just take a look at things. Having access to information like this, like we're sharing right now, this is not something that was very common. The internet has definitely revolutionized everything. Technology is an incredible thing. It is a little bit more than TikTok, believe it or not. And anyone at all, there are people who have the brains but do not have the finances to go to school. But we have people who are extremely smart. We could only get this sort of opportunity to present information like this in a closed environment, now able to just drop it on YouTube.
Yep. Yep.
Information is out there. And at some point in time, there's no one to blame but your laziness. So we're doing our part, and we hope that this is going to be helpful for someone. And hopefully we can also discuss ideas.
No, someone's probably out there saying, "What do I do to exit this fraudulent system?"
Buy Bitcoin.
Not financial advice, but
I mean,
we think it's to that. As a matter of fact, the guy even was mentioned in this video that it's so bad it has entered into the gold and silver space because that's also
dude,
extremely manipulated right now.
Let me just put this right now, and I say, I will need this one in a short for sure, as well, bro. So, gold, okay, is just a scam at this point. Gold is useless. Gold, okay, while it is valuable to create, various things, electronics, and so on and so forth, I will definitely tell you right now, gold is not limited in supply. Okay, if you keep digging, you keep finding gold. All right.
Go together.
So, Mr. Peter Schiff, you will end up with a bunch of bricks that nobody wants. As a matter of fact, guess what? If for some reason we're in a tight position where the government needs a lot of gold, didn't they really shut down your bank, sir? Okay. They will come for your gold.
As a matter of fact, they've seized the gold in the past.
Exactly. So gold does not stand up to Bitcoin, and I just wanted to just go into that little rant just to notify Peter Schiff, because I'll be there the day when his gold is taken, and I don't know if it's gonna be taken, but there's nowhere for him to go to gold, man. Gold is just useless, dude. Let's move on. I just had to divert there for a little bit, right? Now we've seen this happen to the central banks of England before, right? So let's check this part out here.
Policy is, I don't see the benefits of QE that much. I see significant costs, and I would say we need to consider very carefully whether we do it again. But I think I'm with John on this one. But let's other
to give reasons why you can't just undo this.
Well, if the question is, it has to be undone by the banks. Banks are willing to let go the reserves, but they're not willing to let go the liabilities they write on the reserves,
money.
the claims they write.
What, I'm sorry, maybe I would jump ahead, but what if the Fed just started to reduce the bonds, just buy fewer treasuries and fewer mortgage-backed securities?
I was saying, don't do QE in the first place.
No, now, undo it.
It's like crack,
No,
man.
so if it sells,
You can't.
if it shrinks its balance sheet, what I'm saying is the banks are reacting by giving up the reserves and taking the bonds that the Fed sells,
Yep.
and are still sitting with that same level of liabilities that
Liabilities.
they had
Yeah.
earlier.
Yep. Liabilities to you and I.
Yeah, and that's the part that just blows my mind, because it seems that no matter what these people do, the math is not adding up, right?
The Feds are
So
trying to prop up the economy. Of course, we're on the hunt for number one.
yeah,
To continue to be the world number one economy. So of course you gotta just print and make the funds available. But the only way you do that is to create this Federal Reserve bonds out there that the banks buy, and then it's I don't even know what's. Well,
listen,
the banks will not be able to survive or sustain themselves if they don't buy it.
um, I grew up, I grew up in Africa. You grew up in Africa. Uh, People don't have credit cards, okay, and they live just fine. They live within their means. If you cannot afford it, then you don't have it. It's just what it is. If you want to afford it, then you have to make a way to get there. You don't borrow, especially in today's society where people borrow for leisure, right? There is no free liquidity. When you create fake money, there is going to be consequences for this. Let's pull up that chart again. Um, there is consequences to stuff like this when you create things out of thin air. This is what Bitcoin teaches us. You cannot just create energy
Yep.
out of nowhere. There has to be work put in, proof of work, and with that proof of work, you get value, right? So when you create value out of nothing and then you're now trying to pull it back, it does not seem to make sense. And I think that is partially. I don't think we don't need to go into mathematics on this situation, right? I know, and when you look at the PowerPoint, which we'll be linking as well, you see there is a lot of equations and things that these guys use. I'm not even going to stress my brain about it because we're living through the reality of it, and I think anyone can see that. So I think people just need to spend time understanding. I'll tell you one thing that I've understood is Austrian economics, and it's very basic, man. Living within your means, not spending more than you can afford.
Maybe the argument is the government should stop printing, or the government should only print what it needs to sustain the government. Because if that's the case, why don't you just print that same money to pay for taxes? Why we pay for taxes?
Well, that is the biggest scam of the. That's the thing too.
That's a different topic.
When you print money and just pay, yeah, we'll get to that one in a different time. But this is what I'm saying. Bitcoin standard. Period. Final thoughts.
Yes. If you have not liked or subscribed to the channel,
Yes.
please go ahead and do that now. I'm sure you probably enjoy this, or you probably have some questions for us about this. Go ahead and like and comment on that on the video, and let's talk about it. I really don't have a final thought on this. Then just we need to start self-educating ourselves more, so that we don't become slave to the system. There are several scripts out there that says the lender is slave to the borrower. So it seems like the
I think
banks.
it's the other way around.
Well, yeah.
Yeah.
You know me, I'm always flipping stuff around. It's just like banks are slaves to the feds, and we are slaves to the banks. So it's just like a whole cycle here.
Yeah. Are they though? Because they seem to get away with whatever they want.
The banks, yeah, they're making a killing, man. That's why those guys have big yachts.
Yeah, I think the thing is basic, man. Find a way to earn hard money,
Yeah.
right? So that's it. And I think as of right now, Bitcoin is the hardest money we've ever seen.
Yep.
Until next time, ladies and gentlemen. Brazen out.
Double O.